if you're an ASM member, please log in to that form that Sylvia has in the chat group on the right. This will help certify your attendance. Second matter is if you have any questions, please open up slido.com in a separate internet page. Our Slido code number today is 19905. So you can type in your questions there, but if you prefer to answer that, to question that verbally, then just write down your name, says, I have a question, and we'll attend to you right at the end of the session. Okay, let me introduce Hassan. So Hassan is a partner with Actuarial Partners Consulting. He's been involved in consulting since last century, in 1996. He is currently active in IFRS 17 projects here in Malaysia, Sri Lanka, as well as in Saudi Arabia. He plays a number of regulatory appointed actuary roles in lots of interesting countries. There's Malaysia and Labuan, Brunei, Hong Kong, Sri Lanka, gets more interesting, Nepal, Myanmar, Cambodia, Mauritius, Kenya, Uganda, Tanzania, and Burundi. So he's also the co-author of the World Bank book, Takaful and Mutual Insurance, co-author of the book, Essential Guide to Takaful, and a contributing author to the book, Actuaries in Microinsurance and Health Insurance in Asia. He's the external advisor to 2 universities in Malaysia in their risk management and actuarial science program. In his spare time, he helps run a food bank in his adopted country of Negeri Sembilan. Hassan, you ready to start?
Okay, sounds good.
Good luck.
Okay, let me share screen. Okay, hopefully you can see that. Assalamualaikum and good morning. Thanks everybody for coming. It's been a good session putting these webinars together. Actually, we're doing our best to add value in terms of building up your knowledge in terms of Takaful, and then how Takaful fits into IFRS 17. So we have a number of different people here. Some are ASM members and some are not ASM members from all over all sorts of countries and whatnot. I do apologize for those that are logging in from, we have somebody from France, we have people from Nigeria and Ghana and whatnot. I know it's very early in those times, in those places, so our apologies for making this a bit early. One last thing, we have a number of students that are joining this discussion. For the students, I have to say, be sure to focus, because unlike the first 2 sessions, this session is going to get a little bit more complicated. I'm going to get into some of the roughest issues in Takaful and also get into IFRS 17. So you must really focus and pay attention. Okay? In particular, when we talk about Takaful, a lot of times we get caught up in all the religious words, the halal, haram, mudaraba, wakala, all these other Arabic words. When really what we're talking about here, I'm going to keep it to the technical. So the question is, what are the technical differences of Takaful and conventional insurance? And then how do these technical differences have an effect on IFRS 17? I'll introduce that aspect of it. Okay, and we'll get into 3 main things in Takaful. We're going to get into card, which is something people have been asking. We're going to get into surplus sharing. And then we're going to get into setting wakala fees and the discretion by the shareholders and what that means. These 3 issues are actually the same, it's the same basic subject. Okay, so we'll get into that. So for the students, make sure in particular you stay focused. If you get lost along the way, just contact me through LinkedIn or whatever. We can chit chat on LinkedIn, or we can have sessions directly with your class. It's no problem. Okay, so this one is the 3rd session. So we've learned about Takaful as an investor. We've learned about the regulations. Now I'm talking about bridging the gap between Takaful into IFRS 17. Okay, as a consultant, disclaimers first. This is an actuarial talk, but I'm going to avoid actuarial science as much as possible. Okay, so don't be worried that if you're not an actuarial person, not a qualified actuary, you will be able to understand this. I will make this as light actuarially as I possibly can. And then whenever we talk about Takaful, we talk about, people start talking about religion. I'm going to avoid religious issues completely because Takaful is for everybody. It's the concept which is interesting. So we're going to keep it to a technical discussion rather than religious, halal, haram, those kind of things. Okay, so whenever we start, the first question people ask is, okay, why on earth do I care about this subject? Why am I listening to this subject? Good question. Okay, so IFRS 7, this is the first of our webinars. We're talking about IFRS 17. So this is the IASB chairman. So he said IFRS 17 will help investors better understand insurance companies. It's good for investors and good for the insurance industry. Okay. So therefore, a primary goal of IFRS 17 is to ensure financial statements of an insurance company are comparable between insurers in the same market, as well as in very different markets, and give a fair representation of the insurer. This is actually a very interesting goal, and it's a beautiful goal. This is why, you know, a number of actuaries are excited about IFRS 17, even though it's such a technical thing. You know, those of us that do work in a number of different countries, you know that when we look at financial statements, a Malaysian financial statement is not the same as a financial statement in Bangladesh. It's not the same as somebody coming from, you're seeing a company in Jordan or Kenya or something like that. And that's really the challenge. How do you compare these different countries? So this IFRS 17, these guidelines, this rules and regulations for financial statements, they've been developing this for 30 years. So it's been developed for such a long time just to put this together. So this is a very simple goal, but the devil is in the details, especially for Takaful. Okay? And if you go to the IFRS website, they actually have some videos from the chairman talking about this and other things to introduce it. Okay, so what are we talking about today? Today we'll talk about actuarial differences between Takaful and conventional. Again, sticking to pure actuarial discussions, technical discussions, not religious issues. Differences in purpose of financial statements between Takaful and conventional insurance. And then finally, the challenges of ensuring consistent financial statements of different Takaful operators, whether in Malaysia or worldwide. Okay, so I'm going to talk about IFSB. Okay, so when you talk about Takaful, sometimes it's, you know, my point of view, your point of view, everyone's got a point of view. So in this sense, I wanted to go to a standards body which says, okay, these are people which are tasked to determine what is Takaful, what are the guidelines for Takaful, and use them as sort of a standard for having our discussion today. So IFSB is an international body. It sets standards and guidance for Islamic banking, finance, and Takaful. It's more towards a regulatory and supervisory agency. So it's not the same as IFRS. Now this is more for the regulators, but it does give us some good concepts of what is Takaful, what do they feel Takaful should be. They've done guiding principles for governing Takaful, solvency requirements, risk management, re-Takaful, supervisory review process. And then of interest to us is a recent exposure draft, draft 25, on financial disclosures in Takaful. It's a little hard to find it on their website right now, but you can follow that link and you can get to it. Okay. All right. So what does IFSB say about Takaful? I mean, what makes Takaful different than conventional? Again, going beyond the idea of halal and haram and everything like that. So we have multiple funds within one legal entity with different legal rights within each fund. And we'll talk about each one of these things. This legal right is an important one because this can get missed sometimes. When you have conventional insurance, you have a participating fund, you have all different types of funds within conventional insurance. But the legal right is always with the shareholders. The shareholders own the whole company. So what we're saying here is in Takaful, that might not be the case. Second one, a particular fund might belong to participants or the operator, with cash flows between the various funds. So we have different ownership, and we get different cash flows between these different funds. And how does this cash flows between the funds confuse things? And then thirdly, surplus distribution to participants and or the operator from some funds can have many different forms and naming conventions. So again, we'll talk about surplus distribution. Is this exactly the same as a par fund, or is this actually different? So far, so good? Okay, so Takaful as a trust. So Takaful is very much a trust. I'm looking at Malaysia right now. So in Malaysia, we've got different guidelines such as IFSA, TOF, different Sharia laws. And this was explained by Aiza already. So basically, a Takaful fund shall be maintained and managed by a Takaful operator on behalf of and in the best interest of the Takaful participants. So this is why we say we can think of this Takaful as a trust. So you're an Takaful operator, but you're also running a trust. You can think of it just like any conventional trust. If you're running a trust, what does that mean? Okay, and then Takaful fund, as Takaful funds are owned by Takaful participants, this imposes an obligation for a licensed Takaful operator to ensure the funds are established and managed in a manner that preserves the best interests of the Takaful participants at all times. This sounds obvious, but this is an important point as well, okay? Because we see we do work in different countries. Some countries, there are some interesting things going on. So this aspect of TOF makes sure those interesting things don't happen, shouldn't happen. All aspects of Takaful must follow both IFSA and TOF, as well as Sharia law, as interpreted by the Takaful Operators Sharia Council, as well as that of Bank Negara. Okay, so this is just putting Takaful into a, talking about ownership and whatnot. So this makes it clear that in Takaful, the whole Takaful operation is certainly not owned by the operator. Okay, but then the next question is, who does each fund really belong to? So the operator's fund is clear. The Takaful operator receives fees and pays expenses from those fees. This belongs to the operator. Savings fund is also clear. The savings fund, we accumulate savings for the individual participant. This belongs to this individual participant, whatever's inside. The risk fund, okay. The risk fund belongs to participants as a whole. Not one participant, but the participants as a whole. But then if there is card payable, does this change ownership? Card is something where you owe money to the shareholders, to the operator. So if this fund all of a sudden owes money to the operator, are we now changing ownership on this? Does this now still belong to the risk fund if you're owed money? And then is card actually risk transfer? Okay, now why do I get into this? I'm getting into this thing called risk transfers because when we get into IFRS 17, we're talking about insurance. What is insurance? And what is Takaful related to insurance? Insurance is when you transfer risk from one person to a company, such as the insurance company. So if you transfer risk, this is insurance, and you have certain rules involved. Okay. So the question on everybody's mind is this risk fund. Does this risk fund involve risk transfer to the shareholders? In which case, maybe we can say, okay, Hassan, you can call this whatever you want, but in reality, all you're doing is giving another name for insurance. So actually, this thing called Takaful, when you dig down deep enough, is just insurance. If it's just insurance, that means, how it looks like in terms of financial statements, everything like that, should look exactly like insurance. So this is all part of this discussion. Well, the whole discussion here is Takaful exactly the same as insurance, or is Takaful honestly different from a technical point of view? With me so far? Okay, so the question comes up is this thing called a card. People are talking about card quite a bit. All right, so why would a card arise? Well, there's different reasons. One reason, a card means you had a loss, there's a deficit in your risk fund. So something bad happened to your risk fund. So if something bad happened to your risk fund, well, maybe there was a spike in claims. All of a sudden, there was a large number of claims, or a big claim, and your reinsurance was too high, levels was too high, whatever. Okay, so the risk fund had high claims in a year. So you had a loss in this risk fund. So the operator is providing a card, an interest-free loan. Okay, this card's going to be repaid over the next several years as your experience gets better. Okay, so this is loss sharing from one generation of participants to another generation of participants, or participants helping participants. We like to talk about participants helping each other. And the question people ask is, all right, but is this really true? If you look at this particular example, it is true. You had a group of participants and COVID-19 happened. When people bought their Takaful policies last year, how would they know COVID-19 was going to happen? Nobody had heard of this thing, but it happens, or any other, problem that might happen. Okay, so all of a sudden there's this group of policyholders that were insured, Takaful insured during this year. They made a big loss. Okay, so what's going to happen? This loss creates a card. This card's gonna get repaid by next year's participants and the following year's participants. So we're helping each other. Okay, so this is the loss sharing amongst one generation of participants to another generation of participants. Okay? Now the operator will get the card repaid. Again, this is just a one-off spike. This is not like a long-term problem. So the risk has remained with the participants. We haven't transferred risk to the operator, the shareholder. All we've done is just shared the losses amongst different years of participants. So participants helping participants. Okay, so another issue is reserving strains. What is reserving strains? Let's say I price a product. When I price a product, I say, okay, I think 100 people are going to die. Actuaries don't laugh at me, I'm making it simple. I think 100 people are going to die. So I put that into my premium rate, my contribution rates. Okay, let's assume 100 people are going to die. Okay, so when I'm pricing the product, I might assume 100 people are going to die, or I might put a little bit of buffer in there. Say, in terms of pricing this product, I'm going to assume 105 people will die. A little bit of padding, risk adjustment, whatever you want to call it. A little bit of padding there. But reserving depends on the regulator. The regulator might tell us, okay, hold on. I want you to assume 200 people are going to die. So with these very conservative assumptions, my actuarial reserves are going to be quite high compared to the money that I brought into the fund. Because I didn't assume 200 people were going to die in my contribution. I only assumed 100. Okay? So if there's a conservative basis, then there could be deficits, and then a card will be given. So again, reserves will be released over the lifetime of the policy. So again, the operator is not been transferred the risk. The risk is still, with the same group of participants, but we're just, shifting things around. Clear? Okay, so the last one we can talk about in terms of card could be card due to inappropriate, improper, all sorts of sensitive words, risk fund pricing. Okay, why do I call it sensitive? I mean, why would your risk fund be priced wrongly? Well, if you're a Takaful operator and you're pricing rates, third-party motor rates based on tariff, in some countries, it's too low. It's too low. So if you only sold that product, you're going to have a card. This card is going to remain until regulations change, because plain and simply, the pricing is not correct. Okay? If the card is due to blatant errors, you price a product wrongly. You thought 100 people were going to die, but it's because the actuarial analyst that you had doing the calculation forgot to multiply by 10. So actually it's 1,000 people are going to die, not 100. I'd love to say it doesn't happen, but it does happen sometimes. If this happens, then this card is an injection by right. to fix past mistakes. You made a mistake, an operational mistake, whatever you want to call it. The mistakes were made. Okay. Now the third one is it could be due to shifts in reality. For instance, I put medical products here. It's a more straightforward case, but a less straightforward, more interesting is COVID-19. Okay, we know not many people have died in Malaysia due to COVID-19. That's a good thing. But 8,500 over people have actually incurred COVID-19, have gotten this COVID-19. So what's going to happen in the future? Do we know that their risk of getting cancer, heart attack, all the different critical illness is the same now, or is it going to be much higher? There could be shifts in reality that we just weren't thinking about when we priced this product. Who knows? So where possible, the Takaful operator would reprice the product, because a lot of our coverage that we have is not guaranteed risk rates. So the card here is just giving them, again, we're not transferring risk to the operator. We're simply giving the risk fund time to reprice and become profitable again. Once it becomes profitable again, it will be repriced. Okay. The last one, if the Takaful operator sets the wakala fee too high, then this is problematic and could lead to a permanent card. Again, we've seen 80% wakala fees. So we'll talk about this wakala fee in the future, but you've seen from the first session, the first webinar that we put together, that for a wakala model, some of your contribution goes into the wakala as wakala fee, goes into the operator's fund. Some of it goes into the risk fund. So even if your contribution is correct, if too much money goes into your operator's fund, not enough money goes into your risk fund. So your risk fund will have losses. And again, this would be a permanent card. Okay, so these are some of the reasons that a card might happen and how we can think about this when we're talking about card. So whenever we're looking at financial statements, okay, and I say financial statements, an earlier question somebody had is, if I'm a participant, potential participant, I want to buy a Takaful product from somebody, where can I find out whether there's been a card or all this kind of stuff? Do they tell me in my, you have a sales illustration or a brochure, and in the brochure it says, in 2020, we had a $10 million card. No, they don't normally do that. So if your financial statements can clearly show how much card has actually occurred, this would be helpful. And I would take it one step further to say, we need to know why this card exists. Is it a one-off spike in experience? Again, under IFRS 17, this is going to be much easier to check than the earlier days in terms of, has there been a one-off spike in experience, reserving strains, improper pricing, and why. Okay? This will allow stakeholders to understand the health of the risk fund and the reasons for any problems. And again, this is the big picture we should keep in mind when considering financial statements in Takaful. Okay, so would alternative models fix card? We had this question, if we didn't guarantee benefits, or, this is something we're actually talking with a number of people in several different countries right now. Are there different ways of doing Takaful? Is there different ways of putting this together? So let me explain this just for a minute. Insurers don't want to lose money. We know this. So what does this mean? They want to estimate future reality as closely as possible. Okay? So for instance, if you've got, say, just probability of dying, and you're in Malaysia, we've had mortality tables in Malaysia for years. We've got a lot of coverage in force for years. So we can price a mortality product very, very closely because we know pretty clearly what the mortality experience is going to be. We're satisfied with that. When we're developing a product in, say, in Myanmar, which we recently did, there's no mortality table. So we have to look at, okay, what's the probability of somebody dying in Myanmar? Okay, what are the eating habits of someone in Myanmar versus Malaysia or Thailand, neighboring countries with mortality tables? So all this kind of stuff is more variable. And then, for instance, people with cancer, there's no reason why we can't offer insurance Takaful coverage to people that already have cancer. But again, we need to understand reality as closely as possible. When insurers don't understand, have trouble estimating reality, it's harder for them. They have to either build in significant buffers into the rates, or they simply decline these risks. And Takaful is no different. You know, we want to, of course, we want to avoid risks which are likely to cause harm. Okay? So here's where we can do alternative models. We can have non-guaranteed benefits to discretionary mutual is what it's called, to eliminate CARD. In Australia, this would be friendly societies. Discretionary mutual is term for some of those, as well as UK and US, the cooperatives and mutuals and whatnot. So we can design different types of Takaful, which has very different characteristics than current Takaful. So okay, so that's CARD. In addition to CARD, the other main technical aspect normally discussed in talking about technical issues of what makes Takaful different is surplus sharing. The question that I get asked a lot is, well, isn't this exactly the same as bonus and dividends in conventional insurance? To answer that, I normally ask this question for people. So I'll ask you now, what is more fair? Which is more fair to an individual policyholder? Yeah, a conventional participating product or a Takaful product? Which one is more fair to an individual participant, conventional par product or Takaful? The answer is clear. Conventional insurance is more fair. Okay? Maybe you don't understand why I just said that. Maybe you're upset with me for saying that. But that's a truth to an individual policyholder. Okay? And I'll show you why over the next few slides. Okay, let's talk about conventional insurance first. Okay? If you're talking about surplus sharing in conventional insurance, you could have none. It's a non-participating plan. It could be bonuses which remain fixed or in relation to an index. Okay? We see this for some of our countries that we work in. There are bonuses, but the bonuses have not changed in the last 10 years. The bonus rates have stayed, fixed forever, basically. They've got a sales illustration that assumes 4% per annum. They've always given out 4%. So this looks like a participating product, but it's acting like just a non-participating product. And this is going to be an important distinction when we get into IFRS 17 as an aside. Okay. And then same thing with these indexes. Basically, there's no discretion being given by the insurer. They're not choosing to have any discretion over these policies. Asset share styles, UK style, there is limited discretion in smoothing results among differing policyholders. But again, it's very much sticking with individual fairness, or fairness of a very precise group of policies. For instance, if you bought a participating policy in 2019, to find out how much should this belong to this 2019 policies. And you'll keep track of that to make sure that you are getting something fair in terms of your bonuses and whatnot. The fourth one is full discretion. There are policies with full discretion, not in Malaysia, but in some countries. This is like the universal life plans in some countries. You declare your yearly dividend, but the shareholders got full authority over how much they want to declare. And it's a bit of chaos at year end trying to come up with this, what rate should it be? You have the actuary coming up with a theoretical rate, but you also have the marketing guy coming up with a rate that he wants to give based on how competitive it is versus competitors. Then you also have the finance guy coming up with his rate based on how much money he wants to give to shareholders every year. So there is this full discretion type product in conventional. And these products are going to have some challenges, similar to when we talk about Takaful, actually. Okay, so surplus sharing in conventional insurance is for fulfilling promises to share in the results of the company, especially investment returns, not ownership. Okay, so allow me to just focus in on asset share style for just a minute. So asset share style, conventional plans. What this means is you're going to, as a policyholder or participant, you're going to share in the investment, benefit, and expense experience of the company. It's all going to be mixed together. So for every group or cohort, we can call it, of policyholders, so every year, 2019 issue, 2018, 17, 16, you can go by every quarter, whatever you want to do, but year is more common. We would look at what is the investment experience, what is the mortality, critical illness and whatnot, and what about expense. Shareholders are rewarded in line with bonus declaration of policyholders, such as 90-10 rule for Malaysia and most of the British countries. So there is very little conflict between shareholders and policyholders, because the only way shareholders get money is if we declare bonus to policyholders. The more money you give policyholders, the more money we give shareholders. Okay? And then an estate sometimes builds up to smooth experience, but the shareholders are incentivized to minimize this. Okay, so again, there's very little conflict, and regulations are needed to ensure different groups of policyholders are treated fairly. So if you look at the regulations in more advanced markets, they're very much talking about how to keep this different policyholders being treated fairly. So in Takaful, what kind of surplus sharing do we have? Well, we have non-surplus sharing in Takaful. Yes, it exists. It does exist. It's not that common. Why would you have a non-surplus sharing treaty in Takaful? And is that even halal? Well, it's been approved by at least one of the, actually no, two. There's at least two of the Takaful companies in Malaysia. So it has been accepted as being okay. So what do I mean by this? Okay, let's say normally when you don't have surplus sharing, it's because of operational difficulties. For instance, credit card. If you have an Islamic credit card, this credit card, you might have a Takaful coverage on the outstanding balance every month. So in 1 month, there might be a participant has an outstanding balance. In another month, there's no balance. He doesn't have any outstanding balance. So he's a participant in 1 month. He's not a participant in the next month. It's going in and out and in and out and in and out. So with that in mind, it's very difficult to distribute surplus in this kind of a scheme. So you would just leave the surplus in the fund. Okay. It could be only surplus sharing to participants. In some countries, it's always like this. In Malaysia, we used to have products like this. Now we're more like the third type, which is sharing surplus with participants and the operator. And again, in Malaysia, it's a 50-50 sharing. It doesn't have to be. In Malaysia, in the past, we had one fund, which was 80-20. 80% of the surplus went to the operator, 20% went to the participants. So there's no rule which says 50-50 is the Islamically acceptable way. This is more of a business decision, a regulatory decision. Okay, and then the fourth one, maybe the surplus sharing only goes to the operator. I know that one is very sensitive. It happens. Actuarially, we can make this happen. So we're going to teach you some actuarial tricks as to how we can make sure the operator gets all of the surplus. Remember, we were talking about in the earlier session is, would shareholders be willing to accept a low return on capital or Takaful or lower profits? And that's not a given. Takaful can be designed in many ways. This is the beauty of Takaful, but this is also the challenge of Takaful, is that there's different ways of looking at this. There's a lot of discretion involved. So this is what I'm going to talk about after this. Okay? So unlike conventional, in Takaful, we're focused on surplus sharing from benefit results rather than investment experience. Okay? So this is something we need to get across very clearly. In conventional, you have this sharing products, participating products are going to be sharing an investment return, expenses, and benefits. In Takaful, for the most part, it's only benefit experience. Expenses would be somewhere else, and investment would be in the savings fund, which again is somewhere else. Not for all models worldwide, but in Malaysia and in general, this is what we have. Okay, so what kind of sharing do we have in Takaful? Talking about, surplus sharing. Well, we got surplus sharing between the participants and the operator. We have loss sharing between different generations of participants through card. We have surplus and loss sharing between different plans and benefit types. What do I mean by that? If you got one risk fund, and let's take a straightforward example. Let's say you're a general Takaful company, okay? And you sell only two kinds of products. You sell third-party motor and you sell fire. Let's call it pre-liberalization, just to make it totally clear. Fire and third-party motor. Third-party motor is going to be loss-making. The fire is going to be quite profitable. Okay, so this different benefit types, different levels of surplus and profit sharing, this is where things are going to get mixed in. This is an extreme example, but it doesn't have to be extreme. We can look at our normal life family models. You have death coverage, you've got dread disease coverage. When we price these two products, we priced both of them to be profitable, of course. But maybe due to COVID-19, looking next year, let's say that the critical illness was guaranteed, just say. What's going to happen is that there's going to be losses in the critical illness and continued profits in the mortality, let's just say. So there will be some intermixing here, okay? The last type of sharing is asset share type analysis to ensure fairness by group of participants. It's not done as frequently, honestly speaking, except at maturity sometimes. Sometimes at maturity, a maturity bonus that some operators would give, we do some sort of an asset share analysis. Because again, we're here to help each other. So there is intermixing of results. All right, so who is responsible for this surplus sharing? Well, the actuary is one. And this is, again, a big difference in conventional and Takaful. In conventional, the actuary is given a lot of authority over this surplus sharing or bonus rates or whatnot. Of course, now, okay, the board has final say, but most of the time, the board is going to look at the actuary. And I have yet to be the appointed actuary of a company, and you present the bonus rates to the board, and the board says, no, I don't like that bonus rate. We're going to multiply that by 80% and give that to the policyholders. Never happened. So for the most part, the actuary is really, really the ones responsible. But in Takaful, the Sharia Council does get involved. The concept of hiba means gift. It sounds like a nice word, but in Takaful, some of us can get irritated with the use of that word. The concept of a gift with the desire to be fair. Okay, so Sharia Council is also balancing their own issues with trying to be fair to different people. As an actuary, you might say, okay, these policies didn't make any money. They shouldn't get any bonus. This other policies, they made a lot of money. They should get all the bonuses. But the Sharia Council has a say in this. They might say, okay, no, we should be, we should be kind to these policyholders as well. So it is a discussion. Management as well. Management has a say in surplus sharing. Okay, let's say that you can say, okay, that doesn't make any sense. How can management have a say in terms of how much bonuses or surplus sharing I'm going to put? Well, management can simply put a less profitable product into the same risk fund. When they do that, again, we're changing the surplus sharing around. So again, the slide is not so much to be controversial, but more to say there's a high level of discretion in Takaful. This means that more people are involved in the discussion on how to share surplus. All right, so a question came up earlier: is it ethical for the operator to get surplus sharing? And how do we justify this? It's actually a very good question. Okay, so one justification. Again, I'm not getting into the religious stuff, halal, haram. Okay, not at all. I had my own feelings on this, but this is just the common justifications. It's a performance fee. It gives them a bonus for good performance. And this is one where I had a good discussion with one of the older actuaries. His name is he's in Thailand now, but he used to be a main Everybody knows him, the older people in Malaysia. So he said, when we were designing products for them, he said, Hassan, I understand what you're saying. Operators shouldn't share in surplus. You know, this should belong to the participants' money and whatnot. And there was a halal haram discussion involved in there. And not say a gray area is a better way to say it. But you know, as an actuary, if I know the company is going to get a 10%, you know, going to get surplus sharing, it's going to affect the bottom line. I'm going to fight. I have to fight for those rates as low as possible. I'm going to squeeze the reinsurer, the Takaful operator as hard as I can. But if my role is not so much to ensure there's a good surplus in the risk fund, if my role as actuaries to make sure that it's profitable, being run properly, then I'm going to focus a little bit more on services and other aspects. So there's an issue there, you know, and I'm not saying one way or the other, but it's an open issue as to this performance fee and whatnot. It minimizes conflict between the participant and the operator. This is very true. You know, if the operator is receiving part of the surplus, he's got a very strong interest in making sure the risk fund runs properly. Third one, it's a gift from the participants. This is serious. I'm not making this up. A common thing is because the risk fund did really well, the participants are giving a gift to the operator out of the kindness of their hearts. So that is one justification. Okay, so just as an aside. All right, so that is surplus sharing. Okay, so let's get in a little bit on purpose of Takaful financial statements. Okay, now remembering that the very first slide that we had was a quote from Hans, the chairman of the IASB. So he's talking about this purpose of financial statements is helping shareholders and investors. Okay, this is why there are financial statements and why we need IFRS 17 is such a good thing. Okay. In Takaful, we say, yes, totally agree. We do need financial statements which will help shareholders understand the business and potential shareholders and investors and stuff like that. But there's another issue here. And this is where IFSP Exposure Draft 25 talks about this a little bit. The disclosures have a prudential aim in order to ensure the soundness and stability of the industry. So the soundness comes in, so far so good. The second point is the one where we start to diverge a little bit. They provide information to stakeholders, whether shareholders, participants, investors, intermediaries, analysts, or others. So they define stakeholders as being much more, much bigger than just shareholders. And this is important. In conventional insurance, the shareholders own the whole Takaful fund, all of the Takaful funds. It's all owned by the shareholders. So the only shareholder is the shareholder, for lack of a better phrase. It's just the shareholder. In Takaful, the participants own. It's not just the participants are promised certain returns from a fund, you know, and fairness, those kind of issues. The Takaful participants own part of this fund. So with this in mind, the participants are an owner. So the participants' point of view must be taken into account. And this goes for intermediaries as well. You know, imagine if you're a broker and you can send business to 3 or 4 different Takaful companies, let's say. You're acting on the best interest of your clients. You want to make sure you understand exactly what is going on within this Takaful operation. Okay? So this will enable stakeholders to make judgments about the Takaful operation's soundness and how it's being managed. Okay? And their decisions based on disclosed information can put pressure on the firm to manage itself prudently. Okay? And I want you to remember that word pressure. Okay? The word pressure is important later on because we'll talk about how much the shareholders and how you price products, how much of a leeway you have. Okay? All right, so soundness is mentioned several times. Point 16 of that draft explains this quite well. Public disclosure of material information expected to enhance market discipline, provides meaningful and useful information to participants to make decisions on insuring risks with a Takaful operator and to market players. Okay? So to make decisions about providing resources to the Takaful operator. These resources could be, injecting capital, becoming an owner of the Takaful operation. It could be the participant putting his hard-earned money with the Takaful operator. Okay, so there's a very wide range here in terms of soundness. Okay, so assessing soundness can be considered assessing the risks of the operation. Remember, we've heard a few questions on risks over the last couple of webinars. So to be precise, those types of technical risks, which are similar between conventional insurance and Takaful, they're covered quite well under IFRS 17. I mean, we can say what we like about whether we love IFRS 17 or we hate IFRS 17. The reality is it is very well researched, and it does do a good job of getting down to the basics of what is an insurance company. So a lot of the risks are covered very well in IFRS 17. Okay? Risks which are unique to Takaful. Okay, and again, I'm talking about technical, not Sharia. There's a Sharia compliance risk, definitely. Okay, but let's put that one aside. So this risks unique to Takaful relates to higher level of discretion of Takaful operators. Okay, I've already told you about card, the fact that card, there's different types of card. And for a lot of the cases, card is just a shifting of losses around between different groups of participants, not a shifting of risk from participants to the shareholder. I've told you about surplus sharing. Surplus sharing is doing the same thing. You're intermingling different types of policies into one fund, so they're sharing. You have, different years, timing issues. So there's all different ways of looking at this surplus sharing. Okay. Now I'm going to look at the last aspect of this, which is higher level of discretion of Takaful operators through setting of wakala fees. Okay. So for a participant to assess the soundness of a Takaful operator, they must be able to assess the health of particular risk funds. Okay, warning, actuarial science ahead. I'm sorry, just a little bit though, I promise. Okay, so question of the day. What is your wakala fee? Okay, let's say your contribution is 1,000 whatever. Let's say your benefits are going to be 600. Let's say your expenses are going to be 200 or 20%. Okay, total surplus 1,000 minus 600 minus 200 is equal to 200. Your total surplus is 200. For the qualified actuaries, I know I'm totally simplifying this. I get it. Let's just keep it simple for this analysis. What would an actuary complain about? An actuary would complain that benefit cost of 600, this is not fixed. If I know exactly it's 600, it's one thing, but if that 600 is variable, it could be 700, it could be 800. That makes a big difference. Same with expenses. Okay? Close our eyes a little bit to some of these issues, or investment income. Just look at it in terms of this. So how would you set your wakala fee? Would you set it to 20%? The wakala fee covers your expenses. Would you set it equal to 40%? Expenses plus your total surplus. Would you set it to 100%? You can say, Hassan, that doesn't make any sense. Why would you set it to 100%? Well, think about it. Wakala fee of 100% just is conventional insurance, is it not? You took a fee of 100%, you take the whole contribution, you pay everything out of your, life insurance fund. So anyway, I'm just pointing out that you can actually equate conventional insurance with Takaful in terms of product design through wakala fee. There's something we can talk offline about this. Okay, so let's say you thought, okay, wakala fee of 20%. This is a good thing. So 20%, 200. Okay, so your wakala fee is set to cover your expenses. Okay, this is great. That means 800 goes into the risk fund, right? Because your total contribution was 1,000. 200 gets taken out and given to the operator. That means 800 is left and it goes into the risk fund. Okay. Now the benefit cost was only 600. So 200 is your total surplus here. Okay. Now, let's assume surplus sharing is 50-50. So the operator might get 100. Okay. So why do I say might? Might is because this is for one policy. We don't know what the other policies in this risk fund are doing. Okay. This surplus of 200 might be used for something else. You know, there could be other policies which are having poor experience. Could be reserving strain. There's 101 things which could be going on in this risk fund that this surplus could help. Again, participants helping participants. Okay, so now, if the operator does get 100, okay, remember the total surplus was 200. Okay, 100 over 200, this means the operator is getting 50%. So the surplus sharing is 50-50. Clear? Okay, let's say you said, okay, I want a wakala fee of 40%, 400. Okay, so now your wakala fee is set to cover expenses plus all the expected surplus. Thus, this sharing of total surplus is 100-0. See, it exists. You know, you can say technically, officially, it's 50-50 or whatever surplus in the risk fund, la, la, la. Yes, I know. I'm talking about reality. Reality is there's a total surplus of 200. Okay, you set your wakala fee high enough that all of that surplus is going to be inside your wakala fee. So therefore, 100% goes to the operator, none goes to the participant. Okay, so you have two products. They look the same. Just changing your wakala fee changes the whole nature of this product and how this looks and how this acts. Okay, and this is the beauty of Takaful, is that Takaful can mean different things to different people. But this is where disclosure is very important. Okay, so the risk fund will receive 600, which is exactly the expected benefit cost. Let's be honest, this policy is not going to be able to assist any other policies. It's not going to be able to assist with reserving strains or anything else. If there's a shift in reality, benefit cost increases, then there's no buffer at all. Okay, so this is a very different kind of product. Okay, so maybe these were your only two choices, or maybe you were thinking, okay, maybe it could be 30%, split the difference, or whatever it is. Fair, you know. And again, this is why we need to listen to the actuaries and let the actuaries do the testing to show you how products, the nature of the products differ based on wakala fees and how you price them. 50%, okay? You can say, Hassan, don't be silly. How can you have a wakala fee of 50%? It's not as rare as you think, okay? If you take a wakala fee of 50%, then this product is expected to be loss-making, you know? I mean, not in Malaysia, okay? This is not a Malaysian issue, I have to say. Maybe in the past a little bit, but not now. Not now. Bank Negara, our regulator, is very, very good at making sure this doesn't happen, but it's not all countries. You know, I mean, we've had really bitter discussions with Takaful operators in other countries on this kind of issue. The same thing. So, okay, we go to the client and says, okay, the benefit is 600. And the response, I'm quoting, is only Allah Ta'ala knows how much the benefits are going to be. So brother, let's assume 400, not 600. Really happened. I'm not kidding you. So it's not as rare as you think. Okay. Now, are there any other more, less naughty reasons for this kind of thing to happen? Well, perhaps there's excess surplus in the risk fund. Okay, and the operator wants to take that surplus for itself. Just make sure that you declare wakala fee which is too high. That's going to cause losses inside the risk. It's going to cause losses inside the risk fund, and it's going to be able to absorb this surplus. Okay, so again, It sounds clearly wrong, but competition is the challenge. Competition can force the contribution rates down, which should drop just your wakala fee, but normally the companies would keep the wakala fee the same, and this causes losses. Okay, so wakala fee pricing theory. Set your wakala fee to only cover expenses. Take the surplus up front, that 40% wakala fee, but IFRS 17, you got to be careful of this. Those companies that do this right now, their financial statements look really good because they take all the surplus at day one. Under IFRS 17, it's going to be released over time. Okay, that's going to be a big, big difference. You can cross-subsidize products with differing profit levels or maintain segregation. And finally, deal with competition in a way which is fair to the risk fund. Okay, so we can ensure that the financial statements reflect the effect of these different wakala fees on the operator, or to be precise, take into account the level of surplus sharing being given to participants. Okay, including the interaction between different plans and different generations of participants. We can do this. We can model the effect of 2018 policyholders giving some of their surplus over to 2019 policyholders or 2010 policyholders. We can do this. It is possible. As actuaries, it is possible. As an aside, when we do actual modeling of this, it is not the simplest of tasks. One challenge with IFRS 17 is that some things look good in theory, but please, please, please try the modeling first. Because that simple, everything I've been talking about, this cross-subsidization, okay? These are all things which make Takaful beautiful and interesting and different than conventional. But it also could make Takaful a lot harder to model than conventional under IFRS 17. So this is where we have to have a good discussion on what is appropriate. This is where Zaina will come in on Monday's talk. Okay, so this examples above showed that the soundness of risk fund from a participant point of view depends a lot on discretion from the operator in setting their own wakala fees, as well as the fees of other plans in the risk fund. You can look in this part, your plan can have the most fair wakala fees in the world. But if there's another plan inside your risk fund which is looking miserable, you're out of luck. Okay, so there's one section of IFSB. Disclosure should be made for each risk fund, bearing in mind that where there are multiple risk funds, the risk profile may vary from one risk fund to another. Okay, and then my own comment is, from a shareholder's point of view, the experience of individual risk funds is not very relevant. But from a participant's point of view, this information is vital. Okay? And then the beauty of Takaful is participants helping participants. We can't understate this. Whether we're designing Takaful for the first time, whether we're running a surplus sharing, whatever we're doing is, we cannot understate the fact that it's participants helping participants. And we never said Takaful is going to be fair to individual participants. Going back to my original question. In a participating product, asset share style, you get bonuses based on the experience of your cohort of policies. It's fair to you. There is a little bit of sharing, but it's very much fair for you. In Takaful, there's a lot more inter-sharing, a lot of intermixing going on. Okay, so we never said there was going to be fair to individual participants. We do say it's participants helping participants. It's real. It's not just a slogan. Thus, any standards for financial statements in Takaful must bring out this beauty. Okay, so how much disclosure should be mandated for Takaful and what should be optional? Okay, so what IFSB says is it should be presented in accordance with applicable jurisdictions, international standards, which means IFRS 17. So what we're saying is whatever IFRS 17 does should be able to aid comparisons between Takaful operators. Okay. So the challenge is going to be, okay, we've been talking about within a country, all these issues which are totally present in Malaysia and present in other countries which have Takaful, absolutely present. Okay. Now, when we get to comparing financial statements, remember IFRS 17 is talking about comparing financial statements worldwide. They want to be able to compare Takaful worldwide. If you look at Mudarabah in Malaysia, it's totally different than Mudarabah in Sudan, which is different than Egypt. They're totally different. Even though the word is the same, Mudarabah is the same, but in Malaysia, the shareholders, at least the old products, yeah? The shareholders, the operator would get 30% of surplus. That 30% of surplus would cover expenses. In Sudan, the shareholders get none of the surplus. All of the surplus either stays in the fund, which is the one I've seen. Theoretically, it could go back to participants, but expenses are inside the risk fund. Egypt, it's also expenses inside the risk fund, but shareholders can share in the surplus. Okay? Wakala, we've already talked about. You can have all sorts of surplus sharing or different names for all of these things. Even Wakala models, which seem identical, can have very different inner workings. A few years ago, I started working with this one Takaful company. It was fascinating because they got the same 50-50 surplus sharing as a Malaysian company. But instead of paying out that 50% right away, they keep it inside this sort of buffer fund, which is eventually belongs to participants. It'll go to participants, but it hasn't been given to individual participants yet. And what this does is it provides a buffer for card, minimizes the need of card and other things. So even when they look the same, it can be different. And new models from Malaysia with guaranteed maturity amounts, this will challenge this. Okay? So our challenge as an industry is going to be putting this all together. Okay? And this goes to IFSB, which talks about the draft 17, faithful representation means financial information represents the substance over legal form. This is ISB. So it's substance over legal form. Okay, so we need to find out what's really going on. Okay, so to finalize, finish the talk, we're at a crossroads for Takaful. We really are. Will stakeholders see Takaful as identical to conventional insurance in financial statements? Or will the unique features of Takaful be shown? Okay. This is being discussed right now in Malaysia for IFRS 17. This is IFRS 17. This is Takaful under IFRS 17. This is something which, if we don't show this right now, then for all intents and purposes, Takaful might be considered just identical to conventional. Is this what we believe? Is this what we want? So the time is now for you to get involved. Okay, now we'll open this up to questions now, but if you have questions in the future, you're absolutely okay to email me. Go on to my LinkedIn if you'd like. Again, I can chit chat directly with your company if you want, or we can chit chat with your class. I know USIM, UITM, Indonesia has some students coming with us. Absolutely happy for this. Okay, so thank you very much. And pass this over to MC.
Thank you, Hassan. Thank you so much. Did you know that you had 161 participants at the most just now?
Not bad.
Not bad at all. Yeah, and they're very keen. There's lots of interesting questions. But I just went through it while you were speaking. So I'm going to go for the most easy one first, which is right at the end, Sylvia. The last one, just bring that one up first, yeah. Yeah, bring that one up first, yeah. So easy question first, just so that we're all on the same page. Is Wakala fee including commission and expenses and profit margin?
Okay. You guys have an initial answer to that, or want me to straight go?
Straight go lah. That one's
Okay.
easy, kan?
I mean, the reason I say that to everybody else is that we actually have a team of people discussing all of these questions in the background. So I haven't looked at the discussions. I saw the discussions going on, but I'm busy talking. Okay, so there's a halal haram aspect to this, and there's a more practical aspect to this. Yes, your wakala fee includes commission expenses. Commissions plus your expenses are included. That's the practical aspect of it. Now, in terms of, does it go into the risk fund first and then come out? Do you take commissions out before you charge wakala fee? All that kind of stuff. Don't talk about the halal haram. in this, not for this forum. So from a practical point of view, you have a wakala fee. Wakala fee is going to cover your commissions and your expenses at a minimum.
Okay.
The profit margin is what I've already explained in the later slides. I can go over that more offline if you want to message me.
So in Malaysia, at least, because I'm more familiar with Malaysia, the wakala fee that you charge is meant to cover commissions and your expenses, and anything left over is your profit margin. But we all know that, you know, some of our Takaful operators here in Malaysia are still very small, they've not reached critical size. So you might not get enough wakala fee to pay off your expenses. So that's the other reality of it. But it is meant to be used to pay commissions and expenses with the leftover use as profit. Second question. How can Takaful... Sorry, I have a question here from the chat group that says, can you share Slido? So you need to go into another screen, your internet browser, type slido.com and type in 19905, I believe. And that should take you to the Q&A at the moment, so you can type your question there. If you have difficulty, just raise your hand and you can ask your questions directly. So what we're sharing here is actually questions from Slido. So next question, how can Takaful operators recover the cost of providing interest-free card?
You want me to take that?
Sure, I mean.
Okay. No, you guys have good
answers. Go for it, yeah, go for it. Yeah.
Okay.
I'll let you know if we have something else.
Okay, so again, this goes back to what I talked about in terms of why the card came across. Okay, so let's say you had to give a card. So the question is, why did you give this card? Is it because it was a one-off loss? If there's a one-off loss, then you have to assess, is it going to get profitable again? You know, if it's a one-off loss, then you'll get it back over the next couple of years. Okay, if it was due to you priced the damn products wrong,
hey,
don't price the products wrong. Price some profitable products. Right. Most products in Takaful will allow you to reprice. Most MRTT, no. But a lot of the products will allow you to reprice. So if you had a card, it means something didn't work out properly. Either regulations are forcing you to be more conservative, or this tariff which is killing you. It's because the products weren't priced properly. That's how you'd recover the cost. Now, when I say recover the cost, it's recover the card amount, not plus interest.
Yeah.
That's to be clear.
Yeah, but having said that, I think like in Malaysia, they say the FSA says you need to provide financial support. So you can have either, and it doesn't really specify what kind of financial support. So we've seen hibah in other countries, not in Malaysia at least, and we've seen card being offered. But there's nothing to say that you can't structure your card in a Sharia compliant way and recover some cost of providing that card. There's nothing to say that that can't be done. So if you're not happy to give interest-free or profit-free rate, then that's something that you can explore. It's just financial support, right? That was the role, and that's the regulations in Malaysia. In terms of the next question, this is a very tough one to answer, Hassan. I don't know, do we want to take this one first or talk about card? Let's talk. Yeah.
I'm okay with that because I'm going to say no comment. Let me be technically precise. Okay, let me be technically precise.
Yeah, read out the question.
I love this question. I love this question. I love this question. I love this question. Okay, let me answer that in a simple way. Not Takaful. Let's not talk about Takaful. Let's talk about cooperatives. Not like going over to the UK or Europe in particular. They got cooperatives. So the question, a cooperative, it's just policyholders helping policyholders. Are they covered by IFRS 17? Yes, they're still covered by IFRS 17. How they're covered by IFRS 17 changes because the arrangement is different. So what we're coming down to is the whole crux of the discussion next week is going to be, what is Takaful? Is Takaful just a nice, Arabic name for insurance? So if you looked up insurance in Arabic, it's going to say Takaful. Is that just what we're talking about? Or is Takaful honestly different and more like a cooperative. It's not exactly a cooperative as done in Europe because you do have shareholders. But it is what I've tried to show you through this last hour is that it's not exactly conventional either. There are some honest differences. So this is where Zaina will get into it next week, and then Joanne as well.
Okay, so we reserve our comments on this, but it does give you things to think about, right? Okay, the next question relates to the two questions are related. So this question says, can I summarize? If the Takaful operator is managing the risk fund properly, i.e. the tabarruk is priced responsibly, then there is no risk transfer even when there is a card. And following that, next question, similar vein. So when risk transfer is when card is not repaid, right? So in your examples, that will only happen if deliberate mispricing or you've taken too much wakala fee. So it's not on the normal course of business that should be a risk transfer.
Yeah, there's an easy answer and a hard answer. The easier answer is yes, that's exactly what I'm getting at. There is no risk transfer. There's sharing of losses, there's participants helping participants. The whole idea of Takaful is this. Can it happen in real life? Yes, it can. I'd like to say no, but yes, it can. Why do I say that? Let's say you got MRTT, okay? Now, why do I keep talking about MRTT? MRTT is a big mortgage reducing term Takaful. It's a big product in Malaysia, okay? And it's a risk product, you know? A lot of products have a risk fund and a savings fund. And the fee that goes into the risk fund comes from the savings fund. So as long as you've got some extra money in the savings fund, you can increase your charge into the risk fund called tabarruk. You can increase your tabarruk whenever you want if you have to. So even if there's a change in the situation or whatever, if there are these changes, you can still recalibrate your risk fund. But there are types of products where it's difficult to recalibrate. So in this case, I would say 95% of the time, if there is, when a card is not being repaid, it's going to be something went wrong, such as the wakala fee is too high, mispricing. And too high wakala fee sounds like a simple thing. It sounds like, oh, this is really a bad Takaful company. How can you do this? You're being so bad. But it's not that easy. When you set wakala fees, you set it based on how much business you're expected to get over the next, 3 years, 5 years. You're allocating your total expenses. But, agents might have a harder time than you expected. COVID-19 might come and everyone's going to be locked in their house rather than going out selling Takaful. Things happen.
Yeah, things happen. Okay, so the next few questions. So Sylvia, we're done with the first two that you put up here. That's answered. Okay, so the next questions are all relating to 17. So will following the conventional approach to 17 limit and remove the beauty and purpose of Takaful? Will this overcomplicate things for Takaful?
No. Yes, exactly. Okay. And this is, this is what we're discussing right now at an IFRS 17 level.
Yeah.
We want to keep the beauty and the purpose of Takaful intact, but we want to make sure that we're being fair to conventional insurance as well. The fairness goes both ways. When we first started developing Takaful, in Malaysia, we had the first couple of companies around for a while. And then we had a next burst of companies. So when that burst of companies, we worked with this fellow Yahya. So he tried very hard to work with Bank Negara to say, okay, I want non-guaranteed everything. I want there was actuarial reasons for this, RBC charges and things. He says, okay, I wanted this. But in the end of the day, we couldn't get this one settled through just because there's a risk of Takaful companies taking advantage.
Yeah. I think regulators are big on the consumer protection as well. If you're selling MRTT and Motul, for example, they want it to work the same way as conventional products. Yeah.
That's right. So we need Takaful to we need Takaful to look unique and actually act unique. If you want it to look identical to conventional insurance and then not have to obey all the rules of of conventional insurance, well, that's being a little bit unfair, right?
True. Yeah, this overcomplication of things, we're definitely in the deep of things right now. And if you want to have an example, a taste of why things would not be as straightforward as applying, the rules to an insurance company, to Takaful, please, follow Joanne's presentation. That's on Friday, and she'll give an example of why things would be overcomplicated in Takaful. That's not so straightforward. So she'll give you some examples then. Next question. How to ensure regulators understand the difference between conventional and Takaful? I think this must be from a non-Malaysian, as they would most likely approach things with one size fits all.
Okay, you're trying to get me in trouble with Bank Negara. There's a lot of Bank Negara people here, You're going to get me blacklisted for this. No, that's a good question. And that's why I went into the level of detail that I did here. Regulators, all the regulators I've dealt with, most of the regulators I've dealt with have been willing to listen to actuarial science. They've been willing to listen to actuarial science. If you go into the regulator and say, brother, conventional insurance is haram, we must do something different, it's Takaful, they're not going to listen to that. They're following, global standards, they're following all of these things. But if we can show them the purpose behind CARD, intergenerational surplus sharing, we're showing them on technical point of view what makes Takaful different very clearly, then we found regulators to be much more open to taking this into account.
Yeah, and I think you've in earlier presentations, not in this webinar, not in this series of webinars, we've also shown that the Takaful concept is not very foreign. Mutuals in Europe, friendly societies in the US actually have similar approach as well. So it's not something that's very unusual, and regulators should be able to appreciate that. Next question. You mentioned these issues are still being discussed in Malaysia. Not sure what these issues are, but do you see these issues being resolved in time to meet 17 timetable?
You're trying to make me cry. Yeah, that's the challenge. We do have to set this. And it's not just Malaysia, We're talking about globally, because we've done work in other IFRS 17 type work in other countries, and the comment was, oh, Malaysia will figure it out, and then we'll just copy Malaysia. No, the models are totally different,
It's different.
Even if they look the same, there's some very good, strong technical differences here. And yes, it is dragging. I'd love it if,
Yeah, I know. It's like, I think in terms of compliance, perhaps you'll be okay. But the checklist of what needs to be done, you'll be there. But if you're thinking a bit more generally in terms of what kind of products you want to sell, what kind of approach you might be taking, it might be too late if you wait until the last minute to resolve this. So yes, it is a bit more difficult for Takaful.
Yes, so get involved. Get involved. Get involved.
Yes.
Don't wait for your auditors or somebody else to get involved. We always say wait for somebody else to do it. But if you're working in a Takaful company, you know Takaful better than anybody else. You're the best person.
You're the best person to do it. The standards is very actuarial, I find. If you have an appreciation in terms of expected against actual analysis, then you're in a good stead to understand how the 17 should work. The auditors would come from a checklist perspective, right? So yes, get involved. Next question, Indonesia. Wakala fees can be taken from cost of insurance, for example, 50% of COI. What do you think of this design, which is different from Malaysia?
I love it.
We have something similar, right? Not up to 50%, but we have charge on the Tabaro as well.
Yeah, well, we had some particular Malaysia issues involved, which discouraged its use. But let me ignore those for a minute to keep me out of trouble. And just goes directly into the Indonesia case. I love it. I love it. I love it. I love it. Why do I love it? I'm an actuary. As an actuary, I believe in risk management. income, outgo. If my income can match my outgo, then I'm minimizing my risks. There's this mismatch of income and outgo. ALM risk, but it's not investments. It's dealing with, you know, what's coming into the fund, what's going out. So for instance, you have these wakala fees taken off of contribution. Totally understand. You have commissions. Commissions are based on your contribution. If your commission is 10% of contribution, it's you know, there's a direct relationship between your wakala fee relating to commissions versus your wakala fee relating to, you know, something else, you know, what you're receiving. But if you're talking about yearly actuarial work, if you're talking about the audit work that you're doing, when does that come in? That comes in every year, right? So when we're modeling income and outgo, this wakala fee, a percentage of cost of insurance, can match in quite nicely with your outgo. So you can make your income and outgo mesh up. For instance, we did this design for a Takaful company in Saudi. And due to the change in regulators, change in design, they were forced to stop their new business for, I think it was 7-8 years, if I'm not mistaken. They stayed solvent and reasonable over that whole time, just because the wakala fees that we designed were matching nicely with the outgo. So it was able to run independently. So I love the idea.
Sure. Okay. We're going to move a bit more quickly. You're actually way past time. But just before we address another question, we're trying to do these ideas between the partners and actuarial partners. And because of the questions that's coming in, and I think we should have a panel discussion that we'll reserve for Joanne's session. That's the fifth webinar in the series. So let's have a panel discussion. We'll send out an email on that right after Joanne. Then we'll have all the different speakers come on board to answer your questions. And I think I'll send an email, perhaps then you can forward your question earlier on so that we can group it into more meaningful summary to address. Yeah, let's do that. So I'll talk to Sylvia to send that out. Okay, Arif, we know Arif very well. Arif from Brunei. So a very interesting question. Is it halal to transfer a surplus that sits in a participant fund to a new product, which is a really different risk, in a new risk fund? I don't like halal haram questions. You know, I don't know my Sharia stuff very well to call anything halal or haram. But
the challenge, he sees the beard, you know. I mean, so he...
yeah, that question will not be posed to me, right? So can you do that from a halal perspective? I think we're not Sharia scholars to be able to answer that, Hassan. But
no, I mean,
can we actually do that? What do you think?
Okay, I'm on two minds on that, honestly speaking. You know, because there's two ways of looking at this. Okay, so let's say you're allowed to mix these products if you wanted to. Okay, let's just say you're allowed to. Like if you're saying I'm going to take surplus from a life product and put it into a family product and put it into like a moto, that's like a, you know, two different sub companies or whatever. Let's pretend for a minute it's all within family. Okay, you could have designed this product with this very strange risk inside that same risk fund. So you could have used it anyway. So from an all intents and purposes, you know, you could have designed it to, you know.
In Malaysia, I'll tell you what we do in Malaysia. It's actually at the outset when you set up a risk fund. So it's a bit more strict here. So you can't co-mingle your different risk funds. So if you have an annuity fund, you can't co-mingle that with a family fund. If you have, if you've actually have a motor risk pool, you can't share that with a fire risk pool. But if at the outset you only have one risk fund, so you have different types of products in that risk fund. For example, in the general Takaful, you might have your motor and your fire all in one risk fund. Then you are actually cross-subsidizing each other, and that's fine. So it does happen. It depends on how you have set up your risk fund. But if it's a really different new risk fund, in Malaysia, you're not allowed. It's more difficult to do that. So that's moving away from that religious question. But, you know,
that's right. I would have
such. Yeah.
The more I think about it, the more I would have, as an actuary, I would have said no.
Yeah.
As an
And
actuary,
I mean, as well as a participant, right? Because I'm participating in a risk pool that covers motor, for example, right? I didn't sign up to cover some marine insurance.
yeah,
for
no, I
example,
would have
right?
looked at it slightly different though. The reason I would look at it is it's a new risk fund. You see, if you said an older risk fund, it's a different question. But if you say a new risk fund, if it's a new risk fund, why are you expecting a deficit? You know, if you're expecting a deficit, then price the product better, right?
Yeah,
You
that's
know,
the hidden thing, Harry.
so,
Yeah.
so if you say it was a different risk fund, and this risk fund was developing, and over time COVID-19 happened, and whatever happened, okay, I got plenty of surplus in one fund, and you know we didn't expect there to be a problem, but you know, stuff happens.
True. Okay. So
That's a different story.
yeah. To your question, this one's covering onerous contract. So 2 questions on onerous contracts. Treatment, what would be the treatment of card under 17 if the policy is an onerous contract? And the second question related to that as well, IFRS 17, the losses of onerous contract have to be recognized immediately at initial date. Will a Takaful operator avoid losses by repricing the product before implementation?
Okay. I like the second one. The first one, I'd love to save that for Zainal or you know whatever you guys think.
Yeah, I think we're going to be addressing card under IFRS 17 in later webinars, so we'll save that for later. But what do you think about the second question? Can you reprice before implementation?
No, because the question is, I mean, yes, first of all, not even because of IFRS 17. If you're getting losses, reprice the damn thing. Right.
Hey.
you know, seriously. But to go more directly in, is that how do you define onerous? How do you define owners? Honestly. Let's say you have a product which is, these policies are losing money a little bit. But let's say inside that same risk fund, you got policies which are making plenty of profit. Right. This is not conventional insurance. This is Takaful. In Takaful, it's well known. You're going to have products helping each other. So this is a product feature. So I would argue the first step is, do you even have an onerous contract? If there is, you know, methods of shifting surplus around to get rid of this onerous nature. And that's getting the heart of what Zainal's going to talk about next week.
Sure. Okay. What would be the, sorry, what's the next question? That's still on, not that one, so okay, that we'll answer that later. Is there any Takaful product which can be designed that declares no surplus sharing?
Yes, we've seen it. Seen it in Malaysia.
Seen it in Malaysia.
Again, like I mentioned, this is a question of, now when we went to the okay, let me explain.
So to clarify, sorry, Hasan. Surplus sharing here means surplus sharing with the operator, not with the shareholders, right? So surplus sharing with participants?
No, I would have said both.
Both.
Let me assume it's going to be both.
Okay. You just leave it within the fund. Whatever surplus you have, leave it in the fund.
Yes. So let me explain, because I was the actuary when the company launched this product. So I was actually presenting to the Sharia Council.
Okay.
So when we presented to the Sharia Council, we said, yes, surplus sharing is a fundamental feature of Takaful. We understand that. But this is the credit card policy that I was talking about. So credit card, the monthly, policies are coming in and out of the fund on a monthly basis. There was a huge number of participants coming in and out. So it was just too messy to deal with surplus sharing. So that's why we said, I know what the theory is, but operationally, it's just not feasible for us to do this. Allow us to just leave all the surplus in the fund. Participants aren't going to get it. Shareholders aren't going to get it. So we could do that.
Yep. So that's possible. Okay. Last question of the day, which is still related to the accounting standard. Since a Takaful operator is treated as a fund manager, don't you think different accounting standards should apply to 17? And we've had that discussion internally as well. So we're going to save all that 17 stuff for Zainal to answer on Monday.
That's a good way to end this discussion, actually.
Yeah. So
a lot of this stuff is relating the very specifics of IFRS 17, the details, Takaful and IFRS 17. all we can say is stay tuned for Monday. If these questions of IFRS 17 were somewhat above what you're comfortable, what you understand, I highly recommend go to the IFRS website, review a little bit over the weekend, go to my LinkedIn, I've got some articles, go to Zainal's LinkedIn, his articles, you know, read up a little bit on IFRS 17, inshallah.
Yeah. So it's going to be a longer session on Monday when Zainal takes over. And on Friday, Joanne's session is to show examples of that complexity of actually applying the standard. And then we'll follow that up with a panel discussion. So if you have any questions, send that over in advance. We'll send you a link right now. I'll speak to Sylvia about sending you a link in terms of that panel discussion and sending us some questions beforehand. So to wrap it up, Hassan, thank you so much for this webinar. It's been interesting, lots of interesting questions. Thank you. We'll see each other again, hopefully on Monday next week.
Thanks, everybody.
All right.
Bye.
Thank you, everyone.